Welcome to Crypto Prism's channel. Let's take a look at Bitcoin's latest market structure from a structural perspective. This phase of Bitcoin first pushed higher, then, after topping out, it formed a standard decline with lower highs and lower lows. The lowest point hit the previous low at 59,800. After that, it entered into a phase of repeated consolidation and repair. And then until last night, this wave of upward movement appeared. And you can notice the signal, which is consecutive bullish candles pushing the price up. The slope of the move also became obviously steeper. This indicates that short-term funds have started to actively accumulate. The second point is the volume corresponding to the rally expanded significantly. And after the rally, it moved into sideways consolidation, then quickly held the gains, which usually indicates that the rally is a real rally. And the sideways movement is controlling the rhythm. The market is waiting for the next directional choice. The current price is around the 68,800 area, moving in a small range of sideways fluctuations. This belongs to a high-level consolidation zone after the rally. From the perspective of Dow theory, this leans bullish in the short term. If the structure wants to shift from a downtrend into a rebound-type trend, then at the very least it needs to achieve. When pulling back to key support levels, it should not give back the breakout gains from last night. Then on the next upward attack, it should be able to make a higher high, and preferably be accompanied by continued volume expansion. So next, the focus is to watch the resistance zone above, roughly around the 69,000 area. Further up is the round number of 70,000, which is also a typical psychological level, and a prior dense trading zone. A stronger resistance band is around 71,000, which is the previous high point. It is also the supply zone at the top of the previous downtrend segment. This means that if the breakout attempt lacks volume, and the candlesticks show long upper wicks with bullish candles turning into bearish ones, then it is highly likely to be a bull trap style rally and pullback. As for the support area below, first is 68,500 to 68,000. This is the dividing line between bulls and bears after this rally. If this area holds and the pullback comes with declining volume, and the candlesticks do not break down, then it instead represents a healthy continuation of the bullish structure. Further below is the 67,500 to 67,000 zone. This was a position where multiple handovers occurred during the previous rebound. You can see that this area also experienced a period of consolidation. Once this zone is broken to the downside, the structure can easily return to bearish dominance. And the next step would be to be cautious of a pullback toward the 66,000 to 65,500 lower range. So in terms of trading strategy, I suggest not chasing pumps or panic selling, but to act according to confirmation signals. In a bullish bias scenario, wait for a pullback near 68,000 that does not break down and shows a stabilization pattern before following the move, or wait for a volume breakout above 69,000 to 70,000, then enter on the subsequent pullback. The stop loss should be placed at the point where the structure is invalidated. For example, falling back below key support levels in a bearish scenario. If the price repeatedly fails to break above the 69,000 to 70,000 zone, and volume cannot keep up, showing clear rally and rejection, then this area is more like a defensive shorting zone. And the stop loss should be placed outside the upper resistance band. Do not stubbornly hold against the trend. Now let's also look at the daily chart structure. From the daily perspective, it is clearly a one-sided downtrend. From here, the decline progressed in a step-like downward move, and the rebounds during the process failed to make higher highs, which means the bearish trend has been dominant. Until the recent accelerated drop, that bottomed at 59,800, the segment is very clearly an emotional sell-off, accompanied by volume expansion. With concentrated selling pressure being released, here comes the key point. Yesterday printed a relatively long-bodied bullish candle, essentially telling us that effective buying support has started to appear below. At least the short-term bearish inertia has been interrupted. This type of bullish candle usually represents a counterattack from the bulls, and a short-term stabilization signal has appeared. It is not the kind with a very long upper wick. Instead, the upper wick is short, and the close remains relatively strong as a bullish candle. Not a weak fake bullish candle that closes poorly, but a solid real body, which indicates that real buying pushed the price up and defended it. Short-term sentiment shifted from panic to repair, and the completion of bottom handover has improved. If we combine this with the volume of the previous large bearish candles during the sell-off, the bottom clearly showed volume expansion, and right after that expansion, it was followed by a relatively solid bullish candle. This represents that those who wanted to sell have sold, and those willing to take over have started to step in. The market has transitioned from a selling phase to a handover phase, but this does not yet equal a trend reversal. Note that this bullish candle is a stop drop plus rebound confirmation signal, not that the trend has already turned bullish. A true reversal requires the structure to continue forming higher highs and higher lows, and key resistance zones must be reclaimed and held. So next we need to focus on key levels, because the trading logic on the daily chart depends on whether levels are gained or lost. The first resistance above is the 68,800 level we just mentioned, which is also where the current price is located. This area was a key checkpoint of last night's rebound, and also the short-term bull-bear dividing line. Only by holding above it can the short-term rebound have continuation space. The second resistance is the round number of 70,000, a psychological level on the daily time frame, and also previous dense trading zone. If the breakout occurs without volume and upper wicks increase, it is very easy to form a rally and pullback pattern. The stronger resistance band is at 71,000 to 72,300, which is also the supply zone of this downtrend segment. To achieve a reversal, at least this region must be effectively reclaimed. Otherwise, it is still more likely to be just a rebound within a downtrend. As for the support below, it is 67,000 to 66,000. This is a defensive zone during the rebound. As long as the pullback comes with declining volume and does not break down, then the rebound structure remains healthy. The ultimate support is at 59,800. This level is the first line of the bottom. If it gets broken again later, it will no longer be a repair, but a continuation of the trend, and the bears will regain control of the rhythm. So in terms of strategy, I am more inclined to wait for confirmation, rather than being led by this single bullish candle. If you want to go long, wait for the price to hold above 68,800 and 70,000, or wait for a pullback to 67,000 and 66,000 without breaking, and then enter after a stabilization pattern appears. This gives a higher win rate if you want to short. Then focus on the key resistance zone above. If the price pushes towards 70,000 and shows clear volume but fails to break through, with long upper wicks and the subsequent weakness, then after the rebound, it may have already topped out. Alright, that's it for today's video. See you tomorrow.